Have you ever wondered how Warren Buffett, one of the world's most renowned investors, amassed his fortune? If you had invested a modest sum of just $1,000 in his company, Berkshire Hathaway, when he first took over, that humble investment would now be worth tens of millions of dollars, even considering the recent market crash. This translates into an average yearly return of around 20%, outperforming the S&P 500's average return of 10%. So, what's the secret behind his golden touch? Today, we unravel the 6 essential principles that underpin Warren Buffett's investment strategy. 1. Cash isn't always king. Interestingly enough, one principle of Warren Buffett's strategy is quite contrary to a widely accepted notion that cash is king. In Buffett's financial kingdom, cash does not always reign supreme. His unconventional wisdom urges us to transform our cash into assets. But why does he champion this counterintuitive strategy? The answer lies in the inherent ability of assets to appreciate over time, while cash has a tendency to depreciate. Buffett equates having some cash to ensuring there's sufficient oxygen around. It's a necessary safeguard. However, having excessive cash lying around, much like having surplus oxygen, is not just unnecessary, but could potentially stifle your financial growth. Here's a scenario to illustrate this. Imagine you have an enormous pile of cash sitting idle. Sure, it might feel comforting, but in reality, it's just a static pile, slowly eroding in value due to inflation and not working towards your financial growth. In Buffett's own words, I'd much rather own a good business than have cash. This perspective comes from his profound understanding that a thriving business is a productive asset, a golden goose that continually lays golden eggs, irrespective of the economic conditions. In the long run, a solid business can withstand economic downturns, adjusting and adapting, and still maintain its ability to generate income, unlike a pile of cash which stays the same or even depreciates. So the next time you think about stashing your money under the mattress or in a low-interest bank account, remember Buffett's advice: your cash could be working much harder for you as a well-chosen asset. 2. Invest in productive assets. Moving on to the second principle, Buffett strongly advocates investing in assets that are productive. It's crucial to understand what this means in practical terms. Imagine for a moment all the gold in the world condensed into a shiny, dazzling 68 feet cube. You could spend hours polishing it, looking at your reflection, even climbing on top of it for an unbeatable selfie. Yet, despite its physical allure and perceived value, the cube of gold remains unproductive. It won't generate any extra income for you or yield any return on its own. Contrast this with productive assets such as farms or businesses. These are not just static entities of wealth, but dynamic, living organisms that have the potential to grow, change, adapt, and most importantly, produce something of value over time. Take a farm for instance. With the right combination of care, attention, and time, a piece of land can transform into a flourishing farm, providing a steady stream of income in the form of crops. Similarly, a well-run business not only generates income but also has the potential to scale and multiply its earnings over time. Buffett's principle here is straightforward yet powerful. It's not about investing in what glitters, but rather what grows. The essence of this principle is to put your money into assets that can generate more wealth. That's where the magic of compounding comes into play, where your investments yield returns, which are then reinvested, thereby accelerating the growth of your wealth. By directing your resources towards productive assets, you are not just storing your wealth, but actively growing it. You are laying the groundwork for a future where your assets work for you, creating a continuous cycle of value creation that could lead to substantial financial growth in the long run. 3. Stay within your circle of competence. Transitioning to our third principle, let's delve into the concept of staying within your circle of competence. Buffett's idea here is straightforward, yet it carries profound implications. In investing, and life in general, we all have certain areas where our knowledge and understanding are superior to others. These areas make up our circle of competence. Now, the concept is not about becoming a jack of all trades, or trying to know a little bit about everything. It's rather the complete opposite. The idea is to have a firm grasp of your strengths, to understand the limits of your expertise, and then make the conscious decision to operate within those bounds. Drawing on the wisdom of the founder of IBM, Tom Watson Sr., he once remarked, "I'm no genius, but I'm smart in spots and I stay around those spots." That's the power of recognizing and staying within your circle of competence. It's about acknowledging that you don't have to be an expert in everything. Instead, it's about focusing on those areas where your understanding is strong and investing your resources there. So, for instance, if you have spent years in the tech industry and have a profound understanding of its trends and intricacies, then investing in tech companies might fall well within your circle of competence. On the other hand, if you find yourself perplexed by the healthcare industry, it would likely lie outside your circle. The significance of this principle is that it limits the scope for errors. By sticking to what you know, you significantly reduce the chances of making misguided decisions based on unfamiliarity or misunderstanding. In essence, staying within your circle of competence is about playing to your strengths and acknowledging your limitations, a humble yet strategic approach to investing that has served Buffett exceptionally well throughout his illustrious career. 4. Evaluate companies before their stock prices. Now, let's move on to our fourth principle, evaluating companies before their stock prices. This is a significant deviation from the way many approach investing, where the first instinct often is to look at the stock's price and its fluctuations. Buffett, however, flips this conventional approach on its head. The essence of this principle is to shift the focus from price to value. When you first look at the stock price, it's easy to get swayed by the market trends, influenced by the ups and downs. But here's where Buffett's advice comes into play. Before you even glance at the stock price, look at the company itself. Understand its operations, analyze its performance, study its management, evaluate its competitive standing, and ask yourself, what is this company really worth? By doing this, you disconnect yourself from the influence of price and form an unbiased view of the company's value. This method allows you to assess whether the company is fundamentally strong and whether it has the potential to grow in the future. And then comes the stock price. If the market price is substantially less than your estimated value of the company, that's the signal you've been waiting for. It's a clear indicator that the company is undervalued, and it might be an excellent time to invest. This principle is a cornerstone of value investing, the strategy Buffett has championed throughout his career. Remember, the stock market is a tool for buying and selling pieces of businesses, and not merely a platform for speculating on price movements. By evaluating companies before their stock prices, you align your investment decisions with this fundamental truth and step closer to the investing philosophy of the Oracle of Omaha himself. 5. Play big and don't waste opportunities. Switching gears, let's move on to the fifth principle, playing big and not wasting opportunities. Now, you might be wondering, what does playing big mean in the context of investing? Let's unfold this concept through the wisdom of Warren Buffett. Buffett once put forward the analogy of having a punch card with only 20 punches, a card that represents all the investments you can make in your lifetime. Now, think about it. You have only 20 shots, 20 opportunities to put your money where it could grow. It's not about making hundreds of investments, it's about making a few select, high-quality investments. This imagery instantly changes the perspective on investing. It makes you realize the finiteness of opportunities and the significance of every investment decision. Each punch in your card should be a carefully thought out, diligently analyzed, and wisely made decision. This approach encourages you to consider each investment as a significant event, ensuring that you're only seizing and capitalizing on the best opportunities. Playing big doesn't necessarily mean putting in big money, it's about making the big decisions that matter the most. It's about not letting compelling opportunities slip by due to hesitation or fear. It's about the courage to take calculated risks when the reward appears worth the effort. The principle emphasizes not just the identification of opportunities, but also the decisiveness to act upon them. Waiting on the sidelines, holding back due to indecisiveness, or wasting opportunities due to lack of thorough analysis, these are the traps that this principle warns us against. In essence, Buffett's play big and don't waste opportunities mantra is a call to mindful investing, to make every punch count, to take those calculated leaps of faith when the odds are in your favor. So, the next time an investment opportunity comes your way, remember the punch card. Your decision just might be one of the 20 punches that could change your financial destiny. 6. Invest in yourself. Lastly, and perhaps most importantly, the sixth principle centers around you. Yes, you heard it right. It's all about investing in yourself. Now, you might be wondering, what does that mean? Let's decode this principle using the words of Buffett himself. Buffett firmly believes that the most valuable asset you can ever invest in is yourself. This principle may seem obvious, but it's often the most overlooked. We tend to get so involved in external pursuits and material gains that we often forget our most significant source of wealth, our skills, knowledge, and capabilities. Just think about it. No one can take away your knowledge. It's an asset that is completely yours, and with it, you can generate a multitude of opportunities. In the face of any market turbulence or financial crisis, your skills and knowledge remain unaffected and can continue to bring you value. They can appreciate indefinitely, bringing unparalleled returns. Investing in yourself could take various forms. It could mean developing a new skill that gives you a competitive edge or honing an existing one to the point of mastery. It could also mean dedicating time to learn about investing itself, understanding financial markets, reading company reports, or staying informed about the global economy. This knowledge, over time, empowers you to make better, well-informed decisions. Moreover, personal development goes beyond professional skills or investment knowledge. It's about broadening your horizons, enhancing your understanding of the world, maintaining your physical and mental health, and fostering positive relationships. Each of these aspects contributes to your overall success and well-being. In a nutshell, investing in yourself is the most fail-safe investment strategy you can ever follow. As Warren Buffett puts it, the more you learn, the more you earn. So, take that online course, read that book, practice that skill, maintain that healthy lifestyle. Remember, every step you take towards self-improvement is a high-yield investment in the most valuable asset you own, you, yourself. With that said, thanks for watching and until next time.